Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending December 6th, 2024. I'm Preston Brent. Thanks for tuning in. Well, the theme this week, I guess, could be for all year long for 2024. Up, up, and away. I mean, just a very strong year for the markets, followed up from a strong year prior year. Of course, these are two strong years, which you traditionally see coming out of a bear market that we had in 2022. This particular week, the markets finished mixed. All right. I mean, we did see a lot of records this week. We saw the S&P, the Dow, and Nasdaq all making all-time highs. All right. The Russell was the only one that declined after back-to-back weeks of outperformance over the prior couple of weeks. We did get a little geopolitical headline news out of France and South Korea. But those politics and issues there they had a limited impact on the U.S. markets. But just as an FYI, you can see the current forward PE ratios over 23, right? And depending on which data analysis firm you use, it's going anywhere from 22 to 23 and a half. But either way, it's still very high. All right. The current U.S. market valuation relative to the rest of the world on this forward earnings basis is the highest it's been since 1988. And the valuations here in the U.S. market are still over the 90 percentile. So we're very richly set up right now. And I guess thanks to a Republican sweep in D.C., the markets are betting on basically lower taxes, more deregulation. That'll spark a lot more M&A activity. And which also will kind of add to some of the stimulus, pushing the growth rate even higher, right? Since the elections with Trump's victory and the Republican clean sweep in Congress and the Senate, the S&P has gained over 5.3%, Nasdaq nice 7.6, and the Dow up 6%. That's just since the election. I do expect a softening in price going into the early part of next year, but right now we're probably going to be on a nice little road through the end of this year. Okay, you can see this week the Dow was just slightly, even though it made all-time highs for the week, finished slightly in the red. S&P, Nasdaq in the green. Nasdaq had a strong week. Russell in the green or red. Everybody's in the green year to date. I mean, look at Nasdaq over 32% year to date as we round out this year. Okay. You can see the 10-year Treasury came in at 4.17%. So everything's kind of settling in. The best performer for the week was discretionary. And the worst performer, almost to the exact opposite of discretionary, was energy, 4.72 underwater. Annual performance, look at communication services, 40% year-to-date return. That just kind of shows you the bounce off the bear market lows that we had in 2022, Q4 of 2022. That's kind of what we're seeing, I believe. Healthcare, the worst sector, still in the green, just slightly under 7%. And we did get some economic reports this past week, guys. The Labor Department on Friday, the big jobs number, we got 227,000 jobs in November, slightly higher than consensus, although the unemployment ticked up to 4.2, but that was kind of expected. So that moved the markets up a little bit into Friday. All right. And earlier this week, we got the JOLTS report. So the number of job openings increased in October to 7.74 million from the prior month. Okay. And the other headline news we got for this week kind of centered around comments from Fed officials. We got some that are saying they need to slow down the interest rate cuts. But the big key kahuna, Boom Boom Powell, he came out. He's more of a neutral tone. Said the economy's in good shape, but there's no reason for that not to continue. So basically, they're all saying cautious on rate cuts. But I do believe there's still a high likelihood that they will cut rates this December 18th. And then finally, U.S. Treasuries, as you can see, it ended the week at 4.17. It's based on the jobs numbers that we had and everything. Yields across the curve from the short end to the long end of the curve all fell following the release of the jobs numbers on Friday. Okay. And then, of course, if we go over to Europe, over there, you can see this is where some of the issues happen. We saw in France, their prime minister his minority government collapsed after their parliament backed a no confidence vote. When he came out and said he's proposing a deficit reducing budget for 2025, everybody was pissed on that. So Le Pen, who's a conservative counterpart to the prime minister, basically forced a no confidence vote. And generally, the way they measure risk over in Europe is every government debt treasury is compared to the U.S. 10-year government Bund. They call it the Bund in Germany, and it's the highest it's been, 90 basis points, comparing France to the German Bund. So, well, the highest it's been since 2012, let's put it that way. So there's a little bit of risk in the French markets right now as Trump's over there visiting with the opening of the Notre Dame Cathedral. All right, and we're also seeing key macroeconomic data in Europe is still pointing to a very slow economy in Q4. The retail trade volumes here declined in October by 50 basis points. Germany, their manufacturing continues to struggle. Industrial output there fell 1% month over month. Factory orders out of Germany weakened 1.5%. And meanwhile, we are getting in the UK, the Bank of England governor, Andrew Bailey, he said he sees a potential for 4 rate cuts next year. All right. So net, because Europe was all in the red last week, we're getting a little bit of a bounce, a little strong bounce actually this week, even though the economy's slowing down. The key in the markets over there, even though the markets are slowing down, it looks like it's starting to bottom. So you're going to see, because the valuations in the U.S. are so high relative to other countries, you're going to see some money chasing some of that. Although right now, there's still more money flowing into the U.S. markets based on Trump with the lower taxes, deregulation, and all these things that Trump is pushing in the U.S. It's still attracting a lot of money worldwide into the U.S. markets. Okay, so that's what's going on over in the European theater right now. And if we go over to the Asian markets, starting with Japan, they came out, didn't really say anything new. The Bank of Japan, everybody's looking for a rate hike, but they're probably not going to hike. I don't think they're going to hike this year. Probably they may take a little more serious look in Q1. But on the economic front, their wages grew 2.6% year over year from October, and that was pretty much in consensus. And household spending there did fall a little bit, 1.3% year over year. That's the third straight month that household spending fell a little bit. But they're still doing good year to date over there. You can see Hang Seng in China, double digits for the year, but that's what a lot of money thrown in the economy is going to do. Chinese stocks are still anticipating more fresh stimulus measures coming into that market. We did get factory activity there expanded for the second month in a row, which is a good thing. It moved back up over 50 to 50.3. Remember, anything below 50 is contraction, above 50 is expansion. 50 is just neutral. Well, it came in at 50.3. It was at 50.1 the prior month. So anything like that shows a little bit of consolidation is welcomed all across the Chinese and Hong Kong markets. Non-manufacturing of their services activity did fall below consensus to 50 from October's 50.2. Remember, Xi is on this decade push to convert from a manufacturing economy to a consumer-driven economy. Consumers over in China are not spending money right now. They got killed, decimated on the real estate front because most of the wealth in China for the average citizen's tied up in their property and their asset, their house. And right now on the real estate front, the value of new home sales for the country's top 100 developers fell 6.9% in November from a year ago. And that's kind of the opposite of October's 7.1% gain. So it looks like China still needs more stimulus. So we'll see how that plays itself out. All right. Let me switch over. I'm going to just show you quickly some of the major indexes in this short weekend update. I'll start with the E-mini S&P 500 futures. And you're going to see in that particular instance here, you're going to see that we made new highs on December 6th. Intraday up 26.97%. All right. That's intraday highs. Just the markets are just on fire right now. And I think you're getting a lot of that FOMO trade. A lot of institutions, as we move through the end of the year, are trying to add some of these stocks to their portfolio. You can see my pullback point here. This was the original resistance zone. We hit it. Most of my resistance and our support zones, when you blow through that, it's come back and challenged that. So now we've blown through this. It's an Elliott wave 5 up. You can see the MACD's almost running flat. That's a little bit of a consolidation. I suspect we're not going to see too much of a dip here before the end of this year. If we do, it's going to be held up probably around the 59.50 area down to the 50 EMA, which is around 59.10, so 5,900. So right now we're at 6,096. So you're looking at 200-point pullback between now and the end of the year. I don't think that's going to happen. All right. Like I said, any pullback is going to be just a couple of points, 2 or 3% at max, if we get that. And then we're going to probably finish at these highs or maybe slightly higher to end the year. And then January is going to be a whole different game going into Q1. But I'll go into that with our members this Sunday evening, and then for weekly blogs coming up here later on, we'll start to peel out while January is starting to look. Okay, so that's a little bit about what I'm seeing here for the S&P 500. If we come in and we look at the FANG index to show you, we're seeing a lot of money flow back into the mega cap 7 and all these other stocks. You can see the FANG index moved all the way up. This is just Microsoft, Meta, Apple, Google, and Amazon. They made new all-time highs, especially for this year, up 44.51% intraday. The high was made on December the 6th, all right? And if I show you the equal weight, let me just find the equal weight on here, which is the equal weight SPX right here. You can see the equal weight has been falling. So that tells me money's been coming out of to make this rush to the end of the year to get into some of these mega cap stocks. You know, again, it's portfolio balancing is what they're doing. They're cleaning, dressing it up is what they're doing. A little bit of cologne, a little bit of deodorant. That's what they're doing. And we're seeing this. And so you can see the equal weight is coming down a little bit. And it shows up a lot when I do a ratio chart of the equal weight over the SPX, right? Look at that drop off. It started right around November 25th, and then money just flew into the Mag 7 as the equal weight money was coming out, okay? And you could just see it right here. That big drop right there is what's happened, okay? And of course, if we come in here and look at Nasdaq, right, Nasdaq 100 futures, of course, they made new all-time highs on December the 6th as well, right? Up intraday 27.44%, very close to the all-time highs. And then if we look at the composite index of Nasdaq, which is everybody in the Nasdaq, you can see here close near the highs also, up 32.32%. Okay, that tells me that over the past 90 days, the Mag 7 has not done as good as the other stocks in Nasdaq. However, they're playing catch up, the Mag 7 and others, and they're coming on strong as we round out this year. Okay. And then, of course, if we look at the Russell, as I said, it finished in the red this week. You can see here the Russell is backing off, a little bit of a bearish divergence here. So a little bit of a pullback in the Russell. I can see that through the end of this year, all right? So that's a little bit about what I'm seeing there in this. And then, of course, if we look at the the VIX actually closed below a 13 handle, 12.77. We're back in the green here, solidly, okay? And you can see that big gap down and then just the big slow move lower. We haven't been down this low in the green going all the way back to the summer of this year, right? Before we had that big spike in that Japanese carry trade debacle that carried the VIX up intraday to 65.73. That was an anomaly, okay? But anyway, we're back down here again. And as I tell all our members, once we get into the green, you need to be very careful because it's very easy for the VIX to pop back up. I think it's going to stay around this area as we go through the end of this year. And then I think we're going to see a pop back probably in the month of January going into February. Okay. If we look at the front month skew, right? You can see here comparing VIX to December, we're in the green. So we're in a contango environment, or a contango skew is what they call it, which is normal. All right, that means the further dated volatility futures is higher than the VIX, which is what you want to see. And then if we look at the back month spread right here. Let me just see. It should be here. We compare December and January volatility futures well into the green. So that again, the markets are just not fearful going through the end of this year into January as we kick things off. All right. And until Trump takes office on January 20th, everybody's betting on all of the things that Trump campaigned on. Okay. Pushing lower regulations, lower taxes, stimulating key areas of the market, a number of different things that are just going to put this into a normalized skew environment. And then if we look at the December-June volatility futures spread, again, we're well into this. So right now the markets are it's almost like a Goldilocks scenario if you look at it from a market perspective, at least for the net through the end of this year into January. Now I will remind you right after Christmas and the holidays, the end of this year, we're going to go into Q4 earnings, all right, which are coming up about the second week in January. And it seems like we just ended Q3 earnings. We do have some major earnings coming out this week. Members, I'll go through those with you this Sunday evening for our weekly market watch. There are a couple of key ones that we want to watch. Meanwhile, if we look at the U.S. Treasuries, if we look at the 10-year interest rate, you can see this is backing off a little bit, but this Elliott wave would suggest the rates are going to move back up as we go into Q1 of next year. The Elliott wave suggests that the rates will move higher on the 10-year. That'll put a damper on the markets, and it also suggests the Feds may come out December 18th and say they're not going to hike the rates in January. Now, they're not going to say it that way, but right now the markets are only forecasting about an 18% chance of a rate hike in January. And remember, the Feds do not meet in February, and then the next meeting after January is March. So they may cut, or the odds favor a cut this December, and then we may not see another cut until March. All right, so we could see the interest rates drift back up higher again. So that's the 10-year interest rate. If we come down here and look at currencies, we look at the US dollar. Obviously, the dollar loves higher interest rates. And if you look at the Elliott wave count here, this following the interest rates, it's suggesting the dollar is going to move higher going into Q1 of this year. A higher dollar, higher interest rates, a weaker euro, weaker other currencies, whether it's the yen or the pound, Canadian dollar, those that make up the dollar index. So this is suggesting and that'll put a little bit of a damper starting off 2025 in the equity markets. Okay. If we look at the euro, it's going to be just the opposite of the dollar. It's going to be running lower right here. My target for the euro is actually lower. This was my original target right here. And as I said, I generally hit my target. Sometimes if momentum's up, it'll move through the target, then it'll move back up to the target again. If it rolls south of that target, the next area here for the euro is about 102, 103 to the dollar, right? And that would kick the dollar higher, as I showed you. Okay. If we look at the Japanese yen, my target on the yen is also lower, right? That means the Bank of Japan, the markets are forecasting they're not going to cut anytime soon. Remember, the Bank of Japan, they argued about doing hikes. They argued about doing interest rate hikes for 6 months before they actually hike the rates. Now the markets are betting that they're going to hike the rates again, and Japan's saying, well, we got to take a look at the markets. So if they don't hike the rates and they readjust when they will hike the rates, that's going to damage the yen. The yen's going to come down into this area down here. I hope it does, and we'll jump on another long yen trade like we did last time. We did very well with that one. Okay. Then, of course, we come down here and look at metals. Let's look at gold. I'm one of those that long term I like gold, short term I don't. I think you can see how it regained the 50 EMA. I think gold's going to come down, actually take out this low over here that was made over here on that date, right? Back on the middle of November 14th. I think it's going to take out that 2541, go down to 2500, then it'll be worth looking at picking up a buy, right? Silver is going to be the same. In fact, silver, if you look at it, silver is much further. It's been traversing below the 50 EMA. It just regained it. It's found balance at the 50 EMA, just like gold. If they break, they're both going to break, and they're going to come down another 2 or 3%. And that's what I think is going to happen as we go into the new year. Okay. Remember, gold in the month of December is typically a bullish month because you got a lot of big gold buyers. Retail traders are not, or retail consumers buy gold, especially in India and China, and the Middle East. They buy a lot of gold for presents and gifts and things like that around the holiday season, the end of the year. Okay. If we come down here and look at oil, oil I think is going to go even lower. It's in the high 60s, but you can see how it's bounced up. It almost looks like a head and shoulders pattern, but almost like a camelback, right? It's just up and down, up and down. I think that's going to break. This was my original target right here. You can see how it hit it perfectly. It was down on September the 10th. And then I think we're going to break this level. And then the next target that I have for oil is down here in Q1 of next year around the high 50s, right? Once we get down there, then I'll be interested in looking at long positions, right? And we got OPEC looking at taking oil off the market or holding oil off the market. If Trump, now everybody's betting he's going to drill, baby, drill, which means that's going to put more supply on the market, which will move oil lower. But at the same time, he's probably going to put tougher tariffs on Iran. So that's taking oil off the market. And in the middle of all this stuff, you got OPEC trying to figure out what they're going to do. And they've delayed their production cuts and or hikes months at a time until they figure out what Trump's going to do, especially with Iran. But I do believe oil is the higher probability of oil is to go lower. And then, of course, nat gas. I think nat gas is probably a buy the dip opportunity here because Trump's going to open up nat gas exports to Europe and to Japan, where natural gas is 2 to 3 times higher, depending on which part of the planet you're sending natural gas to. Trump doesn't like the idea of Europe buying nat gas from Russia. They're not buying a lot of it, but they've cut down, but they're still buying. Trump wants to replace it with US nat gas, which means we're going to ship more nat gas, which means it should keep the price higher. All right. So that is a little bit about what I'm seeing right now in the markets. Members, I will see you this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in. It looks like 2025 and 2026 and 2027 are going to be very interesting years, and I think there's going to be a lot of surprises in how the markets move. All right, everybody, have a great weekend. Great college football on this weekend for those fans out there. A lot of championship games in all the individual conferences, so I'm sure you'll enjoy it. Members, see you Sunday evening for our weekly market watch. Have a great weekend, folks. Ciao.